Peter Rose, Longwood Currency Trading, late February of 2022. What do you do if you find that you lost 6 times in a row? What happens? What do you think? I mean, other than losing money. Well, look, it's going to depend on, are you a long-term trader, position trader, or are you doing carry trades? In other words, you're going a couple of days in a row, a couple of weeks in a row, whatever with your trade. Or are you a day trader and you're flat at the end of the day? Because it makes a big difference as to how you're viewing your losses. When you become consistent in your trading, you're still going to lose, obviously, and statistically, over a large number of trades, you will lose 6 times in a row. So the fact that you're losing 6 times in a row is nothing to get your shorts in a twist over unless you're trading long term. And the reason for that is because if you're trading long term, let's say you're trading up on the daily. You're not trading every day. Your trades may run anywhere from 4 or 5 days, about a week, to it could be weeks or months. I've been in trades as long as 3 months and wasn't paid for the time that I was in the trade, but that's another discussion. But regardless of that, let's say that you're maybe a swing trader on the 4-hour chart or the daily chart or something like that. You're going to be in that trade for a couple of weeks maybe. So how many times a year are you going to trade? You're trading 2 times a month, right? Let's say you're trading 5 times a month. So you're going to make 50 trades a year. That's not a really large sample size to be using for any kind of statistics at all. You can't even calculate a win-to-loss ratio or any valid metrics on 50 trades. You need 300. If you're just starting out and you're getting your feet wet, the first 100 trades aren't even going to count because you don't know what you're doing. Why would you include shit that you don't know what you're doing into your statistical metrics? Oh, why would you do that? So you got to trade enough until you're making money, until it's working for you, and you're consistent. And I've had videos before about how I define a consistency in the trading. Before you can start using the trades as part of your sample size for calculating any metrics. And so, because you need at least 100 trades before you're going to have any kind of reasonable statistical value. Look, I've written a lot of computer programs in simulation analysis using random number generators, and I've run iterations of rules against certain positions. I'll run those simulations 50 times and compare that with what happens if I run the simulation 100 times. It's different. It's radically different. If I go to 1,000, I'll get much better results, but they're generally fairly close to the 100 sample size. If I run 10,000 iterations through, it's going to be very, very, very similar to the 1,000 value that you get. So just saying, oh, I have a sample size of trades, I have 5,000 trades, and so I'm calculating my metrics over 5,000 trades. I wouldn't do that, because I would never use more than 100 trades in my metrics calculations, simply, and a trade is not staging in or out and counting each one of those as a trade. A trade is you open a position by hitting bid ask, and then you close that position. That's one trade. Now, if you make several additions to that position through the trade, it's still one trade. It's one position that you've opened and closed, regardless of whether you've added 2 or 3 times to that. You don't start out with one lot and add another one and add another one and add another one, and so you've got 8 lots in there, and then you close the trade, you haven't made 8 trades. Well, you have made 8 trades, but you've made 8 transactions that have increased the size of your position. But it's the position that you need to balance against whatever it is that your win-to-loss ratio is. Well, what are you going to do? You're going to calculate the win-to-loss ratio on the 8 different trades that are in there? You're going to add those to your... That doesn't make any sense. I mean, if you don't have any math or statistical background, pay attention to what I'm telling you here, because there's a lot of people out there that think they know what they're doing and they don't, as far as telling you how to calculate metrics. In order to be safe, 100 trades. So I can't help you if you're a long-term trader. I just don't think that if you're getting going and you shouldn't be making long-term trades, because I don't think you're going to learn anything. And if you do know everything that there is to know, then you can do whatever you want to do. You don't have to take my advice. Because a lot of the times, because of the experience I have, I don't take my own advice, because you're doing different things. I mean, if I have a $60,000 bank that I'm trading 6 full lots, I'm going to be doing that quite differently than if I was trading 6 mini lots. All right? And the quite differently is the emotional content of it and staying to my rules, absolutely. Whereas in trading the mini lots, your rules can be a lot looser as long as you've got the right structural methodology behind you. Regardless of all that. 100 trades, okay? Why not use more trades? Well, what do you say you're having a really good run and things are going great for you through those 100 trades, and then you run into just, I don't know, you get sick one time and then you have an emotional problem. Next time you lose your job, let's say, get in a car accident. Over the period of 6 months, you may do 20 or 30, 50 trades or 200 trades or whatever. So now if you're trying to calculate your metrics over that 400 trade process, then they're going to be smoothed out with the good metrics that you had for the first 100, and then kind of complicated by the fact that the next 200 or 300 trades, maybe you were trying a new system, or you just had a thumb up your ass and you were just making stupid mistakes. You don't want that spread out and averaged. If I average 10 pips a trade over a couple of 100 trades, and then I do 40 more trades and I only average 2 pips a trade, and I average all those together, I'm not making 10 pips on average per trade, I'm making 4. But is that the real representation of your trading? No, it isn't. It's worse than that, because you're adding in the good stuff with the bad stuff. So you really don't know that your system has failed you. See? So when you're calculating your metrics, do it in 100 trade blocks. You do 100 trades, calculate your metrics. How am I doing? Oh, I got a win-to-loss ratio of 63, whatever. Then you do another 100 trades. Now your win-to-loss ratio is down to 40. Whoa, what happened? Now you can look at your trades and you can say, well, did I run into the statistical likelihood that I was going to have 6 losers in a row, and I had those in that second 100, but I didn't have them in the first 100. So therefore, it would be all right to blend those 200 trades together to form that smooth average, because you need to include those statistical, they're not anomalies, but they're statistical likelihoods that certain things are going to happen. That's what a win-to-loss ratio tells you, that over a long period of time, you're winning 60% more trades than the 40% that you're losing. Over the long run, that's a good win-to-loss ratio for you. And it's proved out in the fact that you can lose 6, 8 positions in a row and then come back and win 6 or 8 positions in a row. But you have to have the breadth of data in order to give you a good ratio. Now, I need to qualify this by saying that you're going in 100 trade increments to do your metrics. You only do that when you're starting out until you have in a consistent trading environment that you have. You've been able to develop yourself into a consistent trader, and you've done that over the last 300 trades. In other words, the 3 100 period blocks of win-to-loss ratio, average win, you know, number of max losses in a row, average max loss to average win over, you know, all those kinds of metrics that you're going to do. If those metrics are matching up pretty good from each 100 period block over the 300 sample size trades that you've done, now you can go to the 300 sample size. Because what's happened is that you figured out in those 300 trades, somewhere in there you've run into the 6 losers in a row, but you've also traded enough so that you get 6 winners in a row. You've had some really big losses. Yeah, if you're doing stupid risk analysis with every trade you do, that's what you do that. But if you can recover from that, let's say in that 100 block period, oh, I lost 6 times in a row, oh, I gained 6 times in a row, or I gained 3 times in a row, and that made up for the 6 losses because I mitigate my losses better. Well, that tells you something, so that now you're comfortable in taking your entire transaction history over the period of the year and calculating your metrics for the year. But if you spend 3 months and 300 trades and you don't know what you're doing, and you're going to mix those metrics in with what you figure out when you do know what you're doing yourself a disservice, because the strategic plans that you lay out for yourself are going to be skewed wrong, because your metrics are coming out wrong, because your statistics have fluctuated too wildly over the time frames that you're doing. Your statistics should not fluctuate wildly when you know what you're doing. You know, the best example of that is your equity curve. Although I'm not a real huge fan of equity curve itself as a representation of your trading skill. If you're going to base it on an equity curve, then, and I did a video on this not long ago, but you have to have an equity curve that ranges within a certain band of max and min. In other words, your equity curve may be, you know, going like this, but your actual transaction report shows these huge wins and these huge losses. And you really want all of the trades to be averaged in to a narrow band so that your average is a correct reflection of your trading ability. If you have horrendous losses way down here, and then it takes you 9 months to make up those losses with wins, and that gives you that rising equity curve, I'm sorry, but you don't know what you're doing. You can't trust that equity curve because you had all those massive losses. Or if your equity curve is based on these massive wins balanced against massive losses that weren't quite as bad as the massive wins, I couldn't trust your equity curve from a mathematician's standpoint. Remember, I had a degree in physics, almost a minor in math, was a computer software engineer for 33 years, if you don't know my background, real estate investor for 40 years, and retired millionaire from my real estate investments, and got involved in currency trading. But I'm bringing to bear all of that knowledge and experience to the currency markets. My problem is dealing with the emotional trading aspects compared to what you go through in the real estate, because your timing is different on your risk mitigation, and it's really hard. I spent 40 years learning how to do that really well, and it isn't directly, the process is directly applicable into the currency markets, but it isn't mapped the same way that you would if I was to buy another piece of property. For Christ's sakes, I would never buy another piece of property now that I found currency trading. It's funny, all of the a lot of the so-called educators out there are telling you, oh yeah, we're going to make all this money in currency trading, then I'm going to diversify and I'm going to go into real estate and I'm going to do this and that and the other thing. But, well, how confident are you of your currency trading if you're diversifying into real estate? Oh my God, you really don't understand the market that you're in. You want to diversify out of real estate into the currency trading, but you don't want to go the other way. Trust me, I did 40 years in real estate. I think I know a little bit about what I'm talking about. So if you run into those 6 losses, let's not get your bowels in an uproar over this. Let's take a look at your metrics. If you've been trading long enough to have responsible, valid metrics, as I've just been explaining to you, let's take a look at those metrics on a transaction standpoint. What's the variance between the variance between the equity curve and the actual transaction or position closed values compared between the losses and the wins? I mean, you may have to get that spreadsheet out and do some gyrations on that. I've written a computer program that takes all of my transactions and does all this stuff and about like that. So I have that advantage, but if you don't have a program that'll do that for you, some of the broker platforms will provide some minimal metrics calculations for you, and so take a look at that. There's a lot of lower end brokers that won't provide that service for you, but they'll give you 200 to 1 leverage so you can hang yourself and they can make all the money because they're not really an ECN broker. They're taking the other side of the trade, so when you screw it up, they make the money. Why do you think being a currency broker is such a lucrative profession? If you know what you're doing. If you don't know what you're doing, you get hung out too much by giving too many people too much leverage and not managing them or flushing them out before they have a chance to take you down. You know, during the Swiss financial crisis, I forget what year it was, 73, 8, I don't know when it was, but a lot of those brokers got shut down. I mean, they closed down, they went bankrupt. The clients lost all their deposited money. There's nothing they could do. Even the larger firms got hammered really bad, but there were a couple of them that said, regardless of how bad we got hurt, we're going to make our clients whole. And you know, that takes a lot of grapes to do that, and we value those brokers that did that. But in looking at your own trading as a serious trader, because I don't have yahoos watching my channel because I make too much sense for them. They want the magic pill on how you're going to, I'm going to take my $1,000 account and turn it into $10,000. I'm going to do that every year. Terrific. If you think like that and you're watching this video, shut it off. Don't come back and visit any of my videos because I'm not going to make any sense to you. I'm talking about real life trading from somebody who just didn't fall off the back of a truck, okay? And I'm telling you, don't worry about those 6 losses. If you're an active trader, ultimately you're going to hit those 6 losses. But you know what? If you continue to trade, you'll hit 6 winners in a row, and over the long run, they won't balance each other out, because if you manage your risk, if you understand risk management really well, then the winners that you make are going to far exceed those 6 losses to a factor of, well, I'd say at least 3 to 1. So if you lose 6 times in a row and it costs you $3,000, then at the end of the year, when you've had your chance to get your 6 winners, you'll be at $9,000 in the balance of that, up. So don't get frustrated with the losses. It doesn't necessarily mean that your strategy or your methodology or system or whatever it is that you're doing is wrong. It's just perhaps you've got caught in a statistical drawdown period. Correspondingly, don't start strutting your stuff and buying your Lambo just because you win 6 trades in a row and they happen to be big bangers, you know, like maybe an 8 hit or something like that, because that's just transitory. You know, you have to learn how to manage your money. If you've ever played poker before, you learn that's one of the things that you learn is money management. You have to be willing to put your ante in. You have to be willing to throw your money into the pot for the first few rounds to see how things are coming up. But you've got to know, I'm not going to go any further with this, or I'm going to back the truck up and load in. Or just to continue to play around because you think your statistical odds are a little bit better than jump ball, that you play the hand through, or almost all the way through. And I'm not talking about nickel-dime poker either, because how much concentration and investment can you have when the net result at the end of the night is you might win $5 or $20 or $100? You're going to get excited about that? So put what I'm saying in relevance. That's why I talk in terms of the number of losses that you have. I don't know, are those losses $10 or are they $10,000? You know, you have to manage these values by the amount of the bank that you're trading. I mean, obviously, if I say, gee, I just lost $1,000 over these 6 trades. Okay, well, what size bank are you trading? Is that catastrophic for you? If you're trading a $6,000 account with 6 minis and you lost $1,000, man, there's something wrong. That's not statistical. You've got something wrong with your methodology. But if you're trading a $100,000 account and you lost $1,000, that's just the vig, man. That's just your ante. That's nothing. So when you're looking at your statistics, don't look at them in terms of money. Look at them either in terms of pips or percentages of the value of your bank, but don't look at things in terms of dollars. Because 6 losses in a row today might be $500. But in 3 years, when you've been able to build up a bank and you're trading with $30 or $40 or $50,000 account, those 6 losses are going to be much larger. But they will be relative to the size of the bank. What you have to understand is that if you lose 6, 8, or if you lose 8 or 9 or 10, if you lose that in a row, you got to start thinking about whether that's a problem with your system or not, with the way that you're trading, what you're doing. And the reason I say that is because you can, as a good trader, a general trader, the 6 losses, if you're trading a lot, you know, you're making 2-3 trades a day, 3-4 days a week when you're doing your trading, you're actively trading. You're going to get 100 trades out. Well, look, if you trade 3 times a day, 3 days a week, you're 9, say you're doing 10 positions a week, that's 40 a month. So there's 400 in a year. So you're going to get really good statistics over the course of the year's period of time that you're making your trades. And don't forget that when you make the jump from trading a $5,000 5 mini lot account to a $20,000 account, your emotions are going to get kind of jacked a little bit if you haven't had somebody work with you in how to manage your rules as you grow the size of your account, because things change when you pop out of the mini accounts and start trading real money. So you have to be really consistent in your trading in order to trust the metrics that you're being produced at the end of the day, because if you go from a $5,000 account to a $20,000 account and the losses are because you are emotionally stunned by the size of the losses, because you're not thinking in terms of pips, but you're You're going, that just cost me a washing machine. You know, and it's just, you know, it'll rattle you, and that may cause 2 or 3 losses in a row right there. Just your emotional distraught. Okay, so now you start doing your statistical analysis over that, and it's all screwed up. You got to start over again because you're trading with a different bank size, and it has affected your trading because you're losing where you think you shouldn't be losing, or you wouldn't have lost if it would have been a $5,000 account. So balance all this stuff out. But if you're trading fairly regularly, a couple of 3 times a day, 3-4 times a week, doing that fairly consistently, so you're getting a lot of sample data to work with, and you lose 6 trades in a row, you can say, and then you start winning again, you can say, oh, okay, I just hit the statistical likelihood that I was going to hit that number. But if you now lose 8 or 9 or 10 in a row, but you've traded for years, and you've had a couple of 6 drawdowns, but now you've hit a 10, now you got to ask yourself, well, wait a minute, is that necessarily a bad thing? Does it indicate because I've had 2 or 3 6-loss runs in a row that now I hit a 10 or a 12-loss run, is that necessarily bad? In the beginning when you're trading, if you lose 10 times in a row, that's not statistics, that's just you're a crappy trader. But over a long period of time, a statistic, I don't know who the 2 traders are, but they're both in Swager's book, Market Wizards. And they both have admitted to the fact that over the course of their career, they've had, and the career 25 years, 30 years, they've had 2 periods where they've lost 15 times in a row. Well, that's a lot of losses in a row. But over a 25-year period or a 5-year period of time, that's just a statistical anomaly. It's just that shit happens. If you trade enough, you'll lose 15 times in a row. That's not a black swan. That's within the statistical boundaries. And I've got the equations that show you what your win-to-loss ratio is and what your likelihood of 10 losses in a row or 15 losses in a row with a win-to-loss ratio of that. So you don't want to complicate your emotional trading, or you don't want to complicate your trading with emotional problems that really don't exist. If you've got 18 months of trading and you lose 10 or 12 times in a row, you better reevaluate your system because you may be doing something stupid. You might want to find somebody to take a look at it, take a look at what you're doing and say, well, have you thought about this? Because you might not have. You haven't been trading long enough. I've lost 13 times in a row. Now, I've been trading for a couple of years, but I was still suffering fairly badly from my real estate timing disconnect with the currency trading, and so I didn't have enough trades to say, well, I ran into the statistical likelihood that I'd lose 13 trades at some point in a row. I didn't have that many trades. I think the year that happened, I had 400 trades, which I don't know is enough that you would run into a 13-period loser. But I know that I lost the 13 in a row, not because of statistical issues, but just because I was stupid. I did stupid shit. And I've admitted to that. And so when I do suffer a loss, I have to say, well, was that because I was stupid, or was that because I just got hit with it's time for you to have a loss? Look, if you're a 60-40 trader, you're going to lose four times in the 10 positions that you take. You could lose those 4 right up front, and then you'll have 6 winners. That's what a 60-40 trader means, right? Oh, shit. All right. I hope you had fun. I did. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.